from the time of saying we want to sell, let's start a process to actually getting the check for a good size DTC business, it's 6 to 9 months. But before we start that process, we like to do what we call early preparation, which can take 3 months to 3 years. That's sort of the exit ready concept, is that there's so many things that you can be doing to get ready. If you ask most entrepreneurs, do they want to sell on a 3-year view? A good percentage would say yes. So for those people, I would start dipping your toe into understanding the M&A world and thinking about what needs to be done to get you the best terms.
You're listening to Ecom Finance Experts by Finaloop, where we dive into e-commerce finance best practices with the sharpest minds in the game. We're joined here today by Emmet Kilduff. He's the CEO of the Fortia Group. Emmet, great to have you here.
Thank you for having me, Jacob.
So we're just going to dive straight in. You have great visibility. You speak a lot about what's going on in the market in general. What are key trends you've been seeing now? Transactions? What does the market look like in late 24 or late 25?
Thankfully for e-commerce folks, a little bit better than the prior 1 to 2 years. It was tough. Let's jump straight back to the perfect storm was December 2021. That was when we saw the highest multiples, whether that was for a DTC-led brand or an FBA-led brand. Then 23, 24 was really tough, frankly. Just like forget about multiples, even just the ability to get a deal done, let alone price at a good valuation. At our annual New York conference in January 2024, at that point we thought that rates might come down, interest rate might come down in May, June. Unfortunately, that got delayed to September. But that's one of the key drivers of M&A volumes. Once we saw rates come down for a whole variety of reasons, which we can get into, that started to give a little bit of a catalyst towards a better M&A environment. This year at our annual conference in New York in January, there's definitely more optimism as we look ahead to the year that there will be more deals, which is great for all the hardworking e-commerce entrepreneurs who've had a tough time.
Yeah, definitely. I guess we'll kind of see where the market heads in the next. Market's very volatile right now, huge crashes. Any thoughts on that? Like what the interest rates will be looking like in the next couple of months and how that will impact?
Yeah, look, I've been doing investment banking since the year 2000 for 25 years, and I've seen, numerous cycles. M&A very rarely goes down, if at all, for more than 2 years. It did at the dot-com boom and bust. It did at the credit crunch, and it did in the last few years. So I think M&A will bounce back, which basically means there's a inverse correlation to interest rates. Interest rates should continue to go down. I think it's great the election is done. The markets hate uncertainty, so uncertainty of the US election is done. Hopefully there'll be less wars as we finish 2025, and there'll be more peace in the world, and better markets, better stability in markets, and that will continue to see interest rates come down. Obviously, we'll all eyes are on inflation and other metrics, but it feels like there'll be more deal flow as we go into this year. The other way to look at it, of course, is eventually, funds need to do deals. If you're a private equity firm and you raised lots of money from asset managers who've given you money to invest, you're earning fees on that money. So
You need to deploy. Yeah.
you need to put it to work, otherwise they'll want it back. So that's specific to PE firms, but money and the people managing the money want to put it to work, generally, right, as opposed to leave it on the sidelines. So I think there'll be most of the big firms, the investment banks like the Morgan Stanleys where I used to work at, are forecasting increase in M&A this year.
Interesting. And there's a lot of, you're saying, cash that's just waiting to be deployed into the market.
Yeah, absolutely. We've every quarter we do a 50-page report on e-commerce valuations and a webinar to discuss that. And at a couple of those webinars, we've shown charts on the amount of cash sitting on the sidelines, and it's a huge amount of capital, and it'll have to be put to work. Yeah.
All right. Which players are buying today? Who's active in the market, like category wise?
So there are. Let's start with, first of all, by answering what are the types of buyers. We see 5 types of buyers. So in the micro market, which we would suggest is up to $10 million, it's mainly individuals, and that's where we don't play in that space. There's others that are better at us in that space, and we're sort of in the 10 million to $100 million space. So we're working companies with that type of revenue, 10 million to 100 million revenue.
Mhm.
We call that sort of the institutional space as opposed to the micro market or individual acquirer space. There are 4 types of acquirers: family offices, private equity firms, strategics, and the more newer term is aggregators. Or in other industries it's called roll-ups. The roll-ups have been around for decades in software, but in e-commerce the term became aggregator, and it's really 5 years old. Of those who are active, I would say the most active in the last couple of years has probably been the strategics. And bear in mind, there are small, medium, and large strategics, but they, a lot of corporates are sitting on strong balance sheets so that they've been able to do acquisitions. I'd say the least active in the last while has been aggregators, but it's too basic to sort of just say aggregators in one broad brush. The FBA-led aggregators have had a much tougher time than the DTC-led aggregators. Like, a lot of the FBA aggregators are coming to us asking, can we help them sell their non-core portfolios? I don't think I've had that call from a DTC aggregator. So there's been less sort of strategic pivoting and churn from the DTC folks. We have an acquirer conference for e-commerce acquirers again every January in New York, and there are on the DTC side, Society Brands is a good name of a firm that's actively doing acquisitions. On the FBA-led side, Nexus out of Miami is a good example of firm actively acquiring.
Mhm. Interesting. So you're on the sell side, both for companies trying to sell and also for secondary deals, meaning if someone had a roll up or acquired a couple of companies and are looking to pass them on to a different party?
Yeah, absolutely. Yeah, we would sort of still call that sell side, Jacob. But yeah, absolutely. Like, a lot of the aggregators tried to do too many things. They tried to be, great at all categories, sectors, geographies, and I think the ones that were more niche focused probably to a large extent did better, either by geography or by category. And so some firms are narrowing their focus to be really good at one thing, as opposed to not great at lots of things.
Right.
So yeah,
That makes-
we're delighted to help those firms do divestments of their non-core type businesses.
Okay, that makes sense. And regarding this single versus multi-channel, where do you see that heading, and how does that impact how sellable a company is and what their multiples would look like?
Yeah, look, the what do the best acquirers want? They want brands with a capital B that have proper longevity value, that can be real household brands. And the only way to do that is have ultimately an omni-channel approach, right? It can't be just Amazon or just Shopify. It can start on one of those or another marketplace, but it absolutely needs to be omni-channel. The valuation differences, well, the first comment I would say there, Jacob, is DTC-led businesses trade at a much higher value than FBA-led businesses. It's nearly 2x. And that's because for DTC-led businesses, you've got to go out and grab your own customers, find and retain your own customers, which is difficult. You've got to raise money to do it. And CACs are tough, right? It's hard to get customers. So that's the first thing. I think you see it's maybe lower risk to start on Amazon FBA, test out whether a product can get traction, and then go to DTC. But ultimately, I would encourage most FBA type folks to go to DTC because you can get a higher multiple. Now, within DTC, there's 2 types of multiples. There's a multiple of EBITDA or a multiple of recurring revenue. Again, that's a game changer. If you can have recurring revenue, it's a game changer. So, and then if you bring in omni-channel, I'm not telling all these busy entrepreneurs that they have to like do every channel properly, but if you can dip your toe in the water to say do offline through a Walmart or a Target, at least show that you can do it, and then acquire has belief you can enter that channel, and then they pour more resources and more fuel on the fire with financial resource, human resource, then they can take your brand to the next level. So the seller has to leave some money on the table, but they have to show enough belief that it can be a genuine, proper brand with a capital B for the buyer then to really take to the next stage.
Right, that makes sense. Just the kind of general comments we see here at Finaloop, we get a lot of financials, and we see that a lot of times they're not in great shape, and we've seen that impact on M&As and or loans. Do you see that as well? Like, what kind of financials are you usually getting, and like what are key things that brands that might be listening to this should keep in mind to make sure they are exit ready?
Yeah. Yeah. So, I mean, my background is working on Wall Street with very large firms, and generally they're very well prepared. But it doesn't cost that much money to be prepared. Like if you're an S&P 500 company and you're looking to sell, generally you're thinking about that exit 1 to 2 years out. And I would encourage small or medium-sized e-com entrepreneurs to do the same. Get your ducks in a row, right? Get prepared, and find make sure you have a great CPA. If you're large enough, try and think about upgrading auditor. And I would say this, but we can talk about this. Hire an investment bank that can help guide you. We like working with clients who don't want to sell until, say, 26 or 27, because we can add a lot of value,
Right.
by creating an exit ready program for them over 1 or 2 years. And a big part of that is thinking about getting the financials in order, and tracking the right KPIs, etc. So yeah, it's a huge, if you're not prepared, you're going to leave money on the table. That might resonate better with the entrepreneurs, right? Like, don't leave money on the table. Like, you want to have the best terms possible after all your hard work. So please, yeah, get your financials in order.
And do you have like perhaps a recent success story or you could share with us about companies that you've worked with and have managed to get a good multiple and didn't leave money on the table?
Yeah, absolutely. So there's a really interesting story of a brand that signed a term sheet just last week. We started working with it in January 2024 and helping it become exit ready. It was sort of a victim of its own success. The business has been growing like a weed. It did $50 million in sales last year. It's a DTC-led brand, and it's on track to do over $150 million in sales this year. And it had an offer several months ago, but then the business just kept growing so quickly that the offer looked outdated in 4 weeks' time. And it got a little bit ridiculous, frankly, because we'd update the buyer on the business and say, actually, we need a better offer, guys, because the goalposts have moved, and we're not, we can back it up. We've earned the right to ask for more because the financials are doing amazing. And the entrepreneur then eventually became so confident in the opportunity in 2025 that he didn't want to sell the business in its entire lot. So what we've done really is a two-step exit, where he is selling, excuse me, it'll close hopefully in a few weeks. He is selling a minority, 25% of his business, for about $40 million at 11.5 times EBITDA multiple, which is amazing in this market. And he can think about selling the balance in 1 to 2 years, and he's not restricted. He doesn't have to sell it to the investor. He can run hopefully with us a proper auction process in time to sell the balance. So sometimes entrepreneurs think that they have to sell their business in one go, but that's not true. It could be sold in 2 or even 3 lots based on various milestones and metrics. And it's a nice way to take some money off the table, de-risk one's personal life, get some money in the bank account, and then have a sort of a free option on the upside. So yeah, 11.5 times. Obviously, the underlying business is amazing. We found the buyer. It was a great match that we found. So the stars are aligned there. But that's a great live example of a super deal.
All right. That sounds like a very good deal. And would you say for like an average D2C brand selling in 24 or early 25, what would the EBITDA multiple look like?
Yeah, so the range that we publicize at the moment for growing and profitable brands is between 3x EBITDA and 9x EBITDA. There are exceptions to the downside for distressed brands, and there are exceptions to the upside for what we call diamonds, particularly if there's proper recurring revenue, subscription revenue. 3 to 9 is unhelpfully wide, and it's that for a reason, because we see so much. It depends on revenue quantum, revenue growth, net margin, net margin trajectory. It depends on so many things, Jacob, as you know. But I would say for a reasonably growing business with good net margins, let's call it 15% for argument's sake, it's in the upper half of that range. And then it's a question of the terms: how much is upfront, how much is deferred.
Right. And do you see specific sectors within ecom doing better than others?
Yeah, I think again, maybe the sectors that lend themselves to recurring revenue have an easier chance of getting better multiples. So
It's more health and
mm,
beauty, let's say.
yeah, supplements is sort of an obvious one. I'd encourage entrepreneurs to keep brainstorming to see if there's a way to bring in a recurring revenue product into their category, because that's, again, from an M&A perspective, that's when we get really excited. Um, we've seen a lot of aggregators talked about people focusing in on less sectors, less categories, and a lot of the firms are focusing in on health and wellness. So it's definitely a growth area. There's high potential net margins in that sort of category. So it's quite attractive, and there are plenty of acquirers.
Right, right. So we've had this discussion before, and I've had it with other people as well. Something along the lines of businesses are bought, they're not sold. You want to elaborate on that a little bit?
Yeah, it's my favorite quote in M&A. I'm going to get geeky here on M&A, but I think it's the best quote in the M&A space. And um, so what we mean by that is it's, and you can prepare for this, right? So the ideal M&A situation is you get prepared, you're deal ready, you're exit ready, which means that you've got the basics of a data room, you've got your financials in order, you're starting to flirt with buyers. It sort of marries up with a phrase we use: flirt-date-marry, Jacob. Like any great personal relationship, it takes time. You need to flirt, date, and marry. It's the same in business, it's the same in M&A. So if you're flirting with strategics, family offices, private equity firms, aggregators, and by that we mean you're having maybe quarterly meetings with the top targets. You're showing them a one-pager. You're not disclosing anything sensitive, but you're starting to flirt. You're saying this is coming to market next year, for example. Then you start dating. You start spending more time with the firms you think have genuine interest. Then the perfect storm is you have an advisor and you say to the buyer, look, I'm going to work with the Fortia Group to do a full exit process in Q1 2026. If you really like this business, take us off the market. Give us an offer we can't refuse now. And that's when you get bought as opposed to sold, as opposed to going through the full formal exit process. And that's an example as to where you can get a great multiple. A lot of instances, maybe one buyer would approach a seller and they get bought. But in that instance, unless you sort of test the market, you never know what the opportunity cost could have been. You don't know. So if you get a Trojan horse, if you get one offer, that's great. But then I would go to other obvious candidates to sort of double check that that's the best offer. So there's a few sort of types of being bought, not sold. But yeah, that's a great position to be in.
Right. So I guess taking the analogy, you have to date a few people simultaneously to make sure you get the best match.
It can be busy. It needs to be choreographed correctly. I'm not encouraging multiple dating in the personal world, but yes, you are dating, and it, like, that's a great point. It's all about the competitiveness, the FOMO, right? So, and it's across category, across geography. Like, like a lot of some aggregators would talk to each other, and you don't want them all knowing that you're coming to market, or they might even include and agree a price, not to go above. But if you speak to 4 categories of buyers across the United States, Europe, and Asia Pacific, then you sort of you go beyond that, and you started to create FOMO and the best chance of having competition in your ultimate auction.
Right. Right. That makes sense. Just on a dating level, my grandmother, she's in her 90s. She
Good
grew
on
up
her.
in Scranton, Pennsylvania, and she had a lot of dating opportunities until she met my grandfather. So she used to go out with one guy in the morning. He'd drop her off on the curb. She'd walk down and get picked up for lunch. So I guess if you could take that analogy to the investment banking world, you'd be in pretty good shape.
She should have been an M&A advisor.
Yeah, I'm telling you. That's not too late. She's only 92. Um, and how long does the process, like, usually take? Like, if you walk us through just for a couple of minutes, what does it look like?
I think like from the time of saying we want to sell, let's start a process to actually getting the check for a good size DTC business. It's 6 to 9 months. Um, but before we start that process, we like to do what we call early preparation, which can take 3 months to 3 years. So that's what that's sort of the exit ready concept, is that there's so many things that you can be doing to get ready. We talked to a client, or a prospect, excuse me, last week, who wants to sell in Q1 2029.
Oh, wow.
It's doing 50 million revenue last year. It's growing uber fast. It wants an exit for at least 300 million in a couple of years' time. So it wants someone to hold our hand in a white glove way to get there. And we love that type of assignment. We're here for the long term. It's obviously a fascinating business, a high growth business. So the answer, I guess, the right answer to think about it is start thinking about it as soon as you know you want to sell. And I think if you ask most entrepreneurs, do they want to sell on a 3-year view, a good percentage would say yes.
Yeah.
So for those people, I would start dipping your toe into understanding the M&A world and thinking about what needs to be done to get you the best terms.
Right.
And one example, I mean, just a small plug, but this Acquire conference that we host every January, in New York, we're starting to bring some of our prospects to sit there as observers, to sort of understand how acquirers work, to see pitches by entrepreneurs selling their business. Because you can learn so much by being in that environment, to think about, right, what is your turn to get up on the stage and pitch your exit to 100 buyers? What do you say? How do you say? What do you need to say?
Right. It sounds like a practice. And when the process actually starts and you're in the due diligence process and you're uploading everything to data room, are there like recurring issues that come up that you've been seeing across different brands in the space?
The first thing I could think of is that most brands haven't put enough thought into forecasting. And I don't mean, inventory forecasting or demand for, I mean like financial modeling. Like a lot of brands are good at sort of showing their historic financials, their P&L, etc., but they're not forecasting out. Certainly the FBA brands are probably less good at it as the DTC. A lot of like bigger DTC brands have VCs and boards, and so therefore they have to have forecasts, but a lot of the big ones don't. They're bootstrapped, which is amazing. But that's a common thing. Selling a business, whilst the multiple might be on a historic EBITDA or seller discretionary earning number, you do have to sell forward the story, the equity story, the future looking story, because that's what the buyer will inherit and want to grow and wants to see, opportunity, wants to see synergies and opportunities. So that's something that a lot of folks aren't good at. And that's another reason why we like to get involved early, because if we really understand the business early on, we can help craft that story, the growth story, which is key to valuation.
Right. And are people using mainly like is EBITDA the measure versus sellers discretionary earnings in these deals that are, I don't know, $20-30 million revenue? Where do you usually see the cut?
Yeah. I mean, for DTC, it's usually EBITDA. For FBA, it's more SDE. But yeah, once you get to a certain size, it becomes sort of EBITDA, and then it's the question: is the EBITDA adjusted? What are the adjustments? And of course, if it's subscription only, it can be a multiple of revenue, or translated as a much higher multiple of EBITDA.
So if a brand has 10, so I guess just, who would be relevant to reach out to kind of as we bring the ramp to this. So I guess the main criteria would be a brand of over 10 million in the ecom space. Are you in other spaces as well? Like how exactly does that work?
Yeah, we started out in the ecom world, Jacob. So at the moment, we work with companies doing at least 10 million revenue up to 100, 200 million revenue. We started also working with SaaS entrepreneurs and AI and data entrepreneurs. For both of those, it's the same metric. It's at least 10 million revenue. The exception for e-commerce might be if it was 8 million all recurring revenue. That's very different than 10 million non-recurring revenue.
Right.
Yeah.
Got it. And if anyone wants to find out more about you, about reaching out to you, going to your events in New York, what's the best way for them to do that?
Yeah, our website is thefortiagroup.com, FORTIA. And we have a YouTube channel that has all the recordings from that New York conference. And every sort of quarter we publish our latest thoughts and valuations. So that's the best way to sort of see our latest thinking. Yeah.
Got it. Okay. Well, thank you very much. It's been a pleasure.
Thank you, Jacob. Yeah, appreciate your time.